All right. So speaking of capitalism, this is one of the reasons why I wanted to talk about it because we talked about earlier in the week Silicon Valley Bank.
Silicon Valley Bank made too many wise, prudent investments. And what happened is because the country started relying not on its political and administrative processes, but on the Fed, one agency which is supposed to be all wise and all knowing in this arcane thing known as economics. The inflation that was creeping in destroyed reasonability. What happened is that SVB did a lot of investing in long-term treasury bonds, and wise, prudent investments that were not risky, so that some interest could have been earned for its depositors. But what wound up happening is what with inflation, the interest that was otherwise to be earned on these long terms in long term investments just simply evaporated. So they had no long term utility. And they would have been better off and more secure had they made no investments at all, but that would have left their depositors a little upset because there would have been no interest earned. So
Now,
they should have taken more risky investments in short term treasury bonds and uh, more volatile investments on the stock exchanges. And that was not and that is a product of what has happened with investments now. They used to have a thing called long term capital gains, which, being very brief about it, meant that if you kept an investment for 6 months or more and then you sold it or traded it, you only got taxed at a low rate on one half of your gain. If you kept it less than 6 months and you did any of that, then you got hit with a very high rate of taxation on 100% of your gain. So that got wiped out by the Republican Party under the Reagan administration, and we no longer have the long term capital gains penalty for short selling. So instead of the market being directed toward long term stability, which seems to have been what Silicon Valley Bank invested toward, the direction goes to extreme volatility, which, if you have direct access to the floor to trade directly without going through a broker, and you have access to certain algorithms that you can install in your computer system, you can buy, sell, trade instantly, up and down, and you want extremely volatile investments so you can manipulate the market so they will shoot up in value. You sell,
mhm.
they drop down, and then subsidiaries can acquire the things at a very low price and hold on to them for a while, and then you can come back in, drive them up, and then sell more of it, instead of saying 3 years from now, this will be on a steady increase. You don't want that anymore. You want drastic up and downs. And if you have the algorithms based on random mechanistic probability or possibility, you can pretty much calculate what's going to happen mathematically. So you can use your algorithms to say,
Wait,
get,
wait. So
get that.
it's algorithms in the finance industry?
Yes, yes. Everything that you deal with that way is mathematical. If you went to the old LA County Museum 60 years ago, 50 years ago, 45 years ago, and went into the Museum of Science and Industry, they had a huge room filled with ping pong balls, white ones, some red ones, and some black ones. And there was a small transparent box and an arm, and you'd pull the arm down, and randomly these ping pong balls would go in the box. And they were demonstrating what was known as permutations, which is a form of math. I know how to do it, but it's clumsy as hell without a computer. But In other words, what happened is based on the number of ping pong balls in that system, of which there were,
Mhm.
looked like there was more than 1.5 million of the things in there. There were so many, and number of black ones and red ones, and how many went into each pull of the lever. You could hit this thing and it would calculate before you pull the lever as to how many of these balls of each color would be in there, and it would pretty much be on a very, very high percentage of the time. So when you have anything that deals with what looks to be chance and there are known factors in the equation, then mathematically you can pretty much predict with a
Mhm.
great deal of probability what's going to happen, and on average you will win. That's why, unless somebody knows how to do stuff like keep track of and count cards, say in blackjack, the house is always going to win on in Vegas. If you can do the permutations and count cards in your head with blackjack, you'll never lose in the long run, which is why they won't let that type play in a Vegas casino.
Okay, so um, after the Silicon Valley bust or whatever, another bank, and they were seeing several others, but one particular bank, it was trending on Twitter today, First Republic, right? It says it was a deal to deposit $30 billion into First Republic Bank, announced on Thursday, was put together by top power brokers from the U.S. Treasury, Federal Reserve, and banks, including JPMorgan Chase, after a steep decline in First Republic shares. The planned rescue package was discussed by Treasury Secretary Janet Yellen, Federal Reserve Chairman Jerome Powell, and JPMorgan Chase CEO Jamie Dimon early this week. Uh, the prominent figures involved underscore the gravity of the situation in the regional U.S. banking sector hit by the collapse of the Silicon Valley Bank financial on Friday and the shutdown of Signature Bank on Sunday, the second and the third largest bank failures in U.S. history, respectfully.
Why
Um,
that is and why these banks are bailing out another is to get cash on deposit in the bank most likely to be impacted. Why is that so? The problem with a run on a bank is that under American law, the bank does not have to have enough cash available to cover all depositors. What
mhm,
they have to have is a certain percentage of their accounts. Like, in other words, let's say it's 10% that has to be cash on hand. If they've got $100,000 due out on loans and financing on their account books, they only have to have $10,000 in cash, either on deposit in their own vaults or with the Federal Reserve on their behalf. It's not necessarily 10%, but that's just easy to visualize. In other words, for every dollar you've got accounted for that you've loaned somebody or you've invested in something, you only have to have one dime in your pocket in order to do that. So what they're doing is dumping a lot of extra cash, so the investors in that bank will have confidence that if it became necessary to go run on the bank and get your cash, something would be there that would make them less anxious. The other point is that banks are so dependent on each other. In other
mhm,
words, Bank A buys into a finance package that contains Bank B, C, D, and E. And then Bank G, H, and I have invested in one of or two of these other banks. It's kind of like when you go to a movie and you don't just see Warner Brothers, you see Boy Jumped Over the Moon or Amblin Productions, and you have three or four or five studios that have eaten the final percentage of the unadjusted gross out of this when all of the box office is done. So these banks are interdependent, and if one crashes, they all get in a worse situation.
Right. So, because right now it's JPMorgan, Bank of America, Wells Fargo, Citibank make uninsured deposit of $5 billion each into the bank. What? The deal saw large lenders such as JPMorgan, Bank of America, Citibank, Wells Fargo make uninsured deposits of $5 billion each into the bank. Oh. So it's a $30 billion package. Damn.
Yeah, but then again, look what they took under the Bush administration to bail out Goldman Sachs et al. That was 700 billion. And then under the Obama administration, 781 billion, which is $1.48 trillion that was put into this mix to bail out essentially two entities, which morphed into one. Goldman Sachs, Smith Barney, and a few other small ones, which wound up being acquired by Smith Barney, Wells Fargo, and Bank of America. See, Bank of America used to be the mob's bank, and they put their legit money in there long ago. It started in San Francisco. Wells Fargo has been around since the early part of 2 centuries ago. And you have these ancient banking entities that have very, very deep pockets and a lot of cash on hand. Your regional banks are running into a lot of problems, and the Fed does not want any regional startups. What has happened is like your local area cannot get these deposits except when you get an instance where one of the local banks has a fix going on with the local officials. So all of that entity's money goes in that bank. It ramps up what they have, which increases the extent of what they can have on the account books. So what happens is that these big local banks tend not to be interested in small people, small businesses, and ordinary middle class folk who need financing for mortgages and other things, home improvement. And you get deep pockets like the national banks, Wells Fargo, American, Bank of America, Regions, and stuff like that. They have expanded into smaller and smaller urban areas, but their interests are still not quite attuned to the middle class, and that's why it's suffering. Right now, it is a horrible thing in the housing market. There's the entry level housing, the upgrade housing, and then the luxury housing. And the entry level, if somebody already has one, fine, they keep it because they may have 3 or 4% fixed rate they're locked into, which is good. Because if they get another house moving up and they have to sell the first one, their problem is that they're going to be looking at 6.5, 7.5, going on 8% interest, which is, on the average house note, almost $1.50 difference in what you pay out. The middle level stuff, same situation. If you want to upgrade, you have 3% you're locked into right now, 4.5% maybe. But if you try to upgrade, you're going to have a big problem because you're going to wind up paying 6.5, 7% interest on the damn thing, which is ruinous for most people. And the same thing applies to luxury housing. The best thing that a lot of folk are doing, and I sent you an article on that, is renting. Because if you have a property and a mortgage that you're paying on it and you want to move up, move up. If you can find a low rent situation that's not fixed, or one that is not fixed but subject to being changed, buy into it, hope you can get a better mortgage deal later on when the economy isn't so piss poor. And what you do with the property you already have is rent it. And see if you rent it and you are
It pays
astute
for
about it.
itself.
Yeah, well, what happens is when you rent it, you can get your mortgage paid for, you can get your insurance paid for, you can get the property taxes paid for, the upkeep and maintenance paid for, and still have a little bit left over to put in somebody's bank.
Okay.
Now, the problem with this bank is they had a lot of very large companies that were dealing with SVB, and this other bank. And what happens is, let's say, that you only have 200,000 or so that's going to be federally insured. Well, that isn't really your problem. What your problem is you just cut a deal for $28.7 million with another firm that you can make some profit off of. You need some place to conduct that transaction. So you put enough money in a bank like SVB to cover the transaction, but before the transaction is completed, wow, bam, the bottom falls out of it, and you find that you're in an uninsured status. You have problems because what you were willing to put up to complete the transaction and make the capitalistic profit is no longer there. Now, fortunately for those people, it looks like one way or another, under an emergency provision in American law, they're going to cover them even though they aren't nominally covered, which is not unfair, because in this instance, unlike in 2008, it wasn't just financial bullshit going on unsecured and unwise mortgages.
Right. Before I want to go, and so now I want to transition to reparation, because I kind of think that falls under capitalism to a certain degree. But before we get into the San Francisco reparations and the NAACP, and maybe
that San Francisco.
wait, 1 second. I got to do a commercial. This is your commercial. I have not promoted this in a minute. And I was like, I got to remind myself to promote this. Judge Joe Brown barbecue sauce. Yes, go to the website, JJB. Damn, BBQ.com.
By the way, I'm going out to LA next week to do some commercials for this. We are ramping up, and we're now in a number of stores on the West Coast, and that's spreading east. Right now, if you want this stuff, you'll have to go online and get it. And I would suggest a 3-pack, which is most economical when it comes to shipping. And if you try it, you will use it up because it is good.
Right. So JJB BBQ.com. It's good. Good.
Right.
Yes.
Don't judge him, Joe Brown.